Bank of England rates are at their lowest since 1955. Will recent interest rate cuts be enough to improve the current financial situation?
Well, it will help, but they're going to go down further. And they will go down either by another 0.5% or another 1% this coming Thursday. And when the MPC meets and decides, and I think they may go down even further than that. We could see interest rates in this country at their all-time low, which is below 2%.
Okay. And do you think that that would help reinstore investor confidence?
I think confidence has taken a huge shock, and it will take a long time for confidence to be restored. It will help, but there are a lot of things that will have to be done, and I think expansionary monetary policy is one of them.
So what would you say is the single most important change in financial regulation then that you would advocate?
Well, the present regulatory system regulates the individual institutions, and the individual institutions always look to be strongest at the peak of the boom, when actually they're most overextended, and the individual institutions seem to be weakest, effectively when things go wrong at the bottom of the cycle. Now, what you need to do is to have a kind of macro-prudential regulatory system which tightens up and prevents the credit cycle and the asset price cycle doing much further or going much further than it should, as occurred in 2005, 2006. So we want to tighten in the boom and actually relax in the subsequent slump. And that's a change that I want to see brought about.
Would you say that today the biggest risk for developed economies is inflation or deflation?
Both, but one after the other. And the immediate biggest risk is deflation. But the steps that will have to be taken in the various countries to prevent deflation taking hold, which are expansionary monetary policies, cuts in interest rates, increases in the money stock and in the monetary base, higher public sector deficits and rising debt-income ratios, are all the measures that, when things return to normal, could lead to inflation rising very, very steeply. So what we've got to do right now is to expand policies really quite aggressively, but be prepared to reverse them, and reverse them equally sharply, when we get out of this current mess.
It's the question everyone's asking these days, but how do you think that we got into the current mess? What do you think is the
Everyone just got overextended. All the banks had put on enormous leverage. The debt-to-equity ratio, that's the definition of leverage, risen enormously. Banks had assumed, and everyone assumed, that asset prices were going up, particularly housing prices, and had made their portfolio choices on that basis. And then when housing prices started to go down in the United States, because everyone was so overextended, it just snowballed.